All right, so public support for smaller governments. According to Gallup polls, around 52% of Americans prefer smaller government, providing fewer services, while 43% support a larger government with more services. I think the key distinction here is we are not getting a larger government with more services. We are getting a larger government with the same amount and, frankly, shitty quality services as of right now.
Mm-hmm.
So that 43% is a bit deceiving. In actuality, 52%, the more than half of Americans, or just call it half, would prefer a smaller government. Now, that's not to say that you wouldn't have the government functions. That's just to say that the federal government would not be leading the way. The states would go back to their sovereignty, and a lot more of the local governments, the cities, the counties, the states,
Right.
would have more control than the federal governments would. And that might actually be more in line with what the founding fathers meant when they established the country with these separate sovereign states.
Right.
So there is an argument that the federal government has gone a little bit over the top. Now, all of this comes back to one central financial point. It is a financial literacy podcast.
Let's do that, yeah.
Yahoo Finance. Well, we got some inflation numbers that came out, and where inflation is and isn't. You've heard us talk about this on the show for quite some time. Auto insurance still leading the way at 14%. But notable callouts from Wednesday's inflation print include the shelter index, which grew 4.9% over last year and contributed to over 50% of the monthly increase overall. Meanwhile, the energy index held steady month over month after decreasing by 1.9% in September. On a yearly basis, the energy index was down 4.9%. So we're seeing some things I think that are pretty similar, but there is a reoccurring theme here with inflation, and that's auto insurance being by far and away the highest, 14%. But below that, rent, housing, airfare, restaurants, education, medical care, earnings, household energy, all above overall inflation's numbers of 2.6%, which actually rose from 2.4%.
But that came in at the expectation, right? It was expected for it to rise to up.
It was expected to rise. So,
but after this print came out, I believe we're now sitting at an 80% chance at a rate cut in December, and actually a slight, like a 10% increase, was at like 14 to now 24, 25% chance at a rate cut in January.
Yeah, and look,
which it makes you think, like, wait, inflation went up from 2.4 to 2.6%. That's the headline figure. I mean,
the problem is jobs are getting a little weird now.
Yeah, what do you mean?
The job economy. So the Fed has dual mandates, right? And very prominently, one of those mandates is jobs.
Okay.
Stability of the job environment.
Providing maximum employment. And that last jobs print that came out only added 12,000 jobs,
which was wildly lower than expectations.
Exactly. All the other expectations always had gone the other way, and that it was almost like that's the print that they needed to allow them to continue to keep their foot on the gas with cutting the rates. Otherwise, if the expectation of this inflation report is that it will rise, that goes against any reasoning or rationale you should have to cut rates. If anything, you stay pat.
So government spending can inflate GDP, right? But shelter, housing, and rent, which are the number 2 and number 3 components contributing to inflation here, have been a large part of the problem. That being said, if mortgage rates aren't going down because the bond market is acting in a very unusual way and they're going up, which we predicted on the show and we're seeing now, then that's going to drive rent and housing down, and it might actually drive inflation down despite the FOMC cutting the Fed funds rate.
Interesting.
And we have a chart. Haroon, if you could scroll up to the next chart on the next page there. Thank you very much. Housing costs are keeping inflation over 2%. This again from Yahoo Finance. The latest Consumer Price Index, CPI, report out Wednesday showed that housing costs accelerated in October, posing a lingering challenge to the Federal Reserve's inflation fight. Data from the Bureau of Labor Statistics showed shelter costs, the largest component of CPI, ticked up 0.4% compared to the previous month in October. Thank you, Haroon. This was higher than September's 0.2% increase and accounted for over half of October's overall monthly increase. On an annual basis, shelter costs rose 4.9% in October, matching September's year-over-year gain of 4.9%. A direct quote here from Robert Frick, Falling inflation hit a snag in October with the usual culprits: rising shelter and food costs, something that we're all paying.
Mhm.
Robert Frick, corporate economist with Navy Federal Credit Union, wrote in a note after the release, given food, transportation, and shelter are the top 3 pain points for consumers, this report didn't ease the burden of high prices. Economists have been long anticipating a slowdown in rent increases, which has been reflected in other data, but a widespread cool down in rents hasn't yet shown up in the CPI report. Keep in mind, this is a lagging indicator. It usually takes about 6 months before you see it. So if you take that assumption and you push it forward, then you are at the Fed's overall inflation target now. Once that lagging data comes in,
Yeah.
jobs are already below their mandate. So they're already thinking, okay, we have some instability in the job market. So if we remove for these costs, which we know are lagging indicators, and we know that the mortgage market isn't going down, we should align to our target inflation point even while we're cutting